Hey guys, it's John here. In this video, I want to talk to you about the Facebook stock analysis and why I believe that the market has lost its mind. The Facebook dropped about $250 billion of market cap in the last 2 trading days just because they missed the EPS by 4%. But that was $250 billion. However, this video, I want to talk to you about the risk of Facebook and whether we see any opportunity to buy into the market. I want to talk to you about the MOAT, the business model, the competitive advantage of Facebook. In my personal opinion, I will show you the numbers, I will show you the fundamentals, I will show you also the technical analysis and my valuation. However, this video is not a financial advice. Please do your own due diligence. This video is not recommending you to buy, sell, or hold any of these Facebook stocks. This video is for general entertainment purposes only. Please do your own due diligence, do your own valuation. So without further ado, let's get straight into it. All right, so I believe that the market has lost its mind. They only missed the EPS by 16 cents. Their EPS is about $3 something. And the share price dropped 26%, wiping $250 billion of market cap, which doesn't make sense in my opinion. Because if we look at the Facebook last missed EPS, the quarterly EPS, it was in Q4 2019. Okay, so if I show you here, okay, so this is all the earnings history of Facebook. You can see they missed by 15 cents, but they actually beat the market by $230 million. And then if we look at the last one was they missed by 1 cent in December 2019. So I personally believe, and since 2017, there's no EPS, they're all just better than estimate. They missed here the revenue, and then they missed it also in 2018 here. So I personally believe that it's just an overreaction. And then let's talk about why the stock prices dropped. The first reason was because the Apple iOS changes. They are giving Apple user, an option whether they would like to receive targeted ads from Facebook. And according to Bloomberg, 75% of them have opted out of Facebook tracking. And this has impacted the bottom line. This has impacted the revenue in the last quarter. And I think it's going to impact the revenue going forward as well. So that's the risk. And then this is why the analysts and the market doesn't like it. The next one is there's a weak revenue guidance by the CFO, 3 to 11% for the next quarter. But in saying that, the CFO, they're known to give weak guidance in the past, very conservative, and then continue to surprise the market. As you can see here, they just surprise the market most of the time. And also they also mentioned that the Reels monetization has been lower than the feed and stories. As you know, Facebook is competing with TikTok. If you would like to capture the market or the TikTok customers, it makes sense for the company to lower costs for the advertiser in Reels because they would like to compete in TikTok. So it doesn't really make sense to actually charge higher when you wanted to get more attention from the advertiser. It doesn't make sense. So it's normal, it's normal business practice to offer lower price, which I think this is actually positive. And another one is also the monthly active users, they have plateaued. If we look at here from Bloomberg, you can see the June, September, December quarter, they are very close. You can see the growth has slowed down, which is expected. Okay, Facebook is one of the biggest social media company in the world, and then it makes sense for them to slow down their user growth. You can't grow forever. You can't grow in the same pace when Facebook was a small company, which doesn't make sense. So this is why people scared. We can see there's no dip. If there's a dip going forward, then I'll be more worried about it. All right, but in my personal opinion, if you look at this chart, if you look at this graph, you can see Facebook is number 1 still, YouTube the second biggest one, and then WhatsApp. I personally use WhatsApp. Everybody that I know, they all use WhatsApp. Everybody use Instagram. WeChat is mainly in China, or Chinese people around the world, they use WeChat. And the next one is TikTok, which is just a little bit higher than the Facebook Messenger. So the moat, the competitive advantage of Facebook, I think they still have years ahead. If TikTok is going to overtake them, I think it's going to take them, I don't know, 3, 5, 10 years maybe, if they're successful. Yeah, so that's, even though they have plateaued, but that's okay. All right, now let's talk about the moat or competitive advantage of Facebook. And then this is more like a fundamental analysis. If we look at the growth, they've grown for 23.74% year on year in the last 5 years. Okay, that's amazing. I give it a thumbs up there. Something that this is sort of like my checklist as well. We look at the profitability. Gross profit margin in the last 10 years is 82%. Net income margin in the last 5 years is over 30%. These are just amazing numbers. These are like money-making machine, in my opinion. If you look at the management effectiveness, the return on equity is over 20%. Return on invested capital is over 20%. It's just, this is what I would call, what Warren Buffett would call a wonderful companies. And if we look at the balance sheet, the current ratio is 3. Like anything above 1.5 or 2, they are already pretty safe. They're pretty strong balance sheet. And then if we look at the debt to equity ratio, they are 11.57%, which is very low, not much debt. The shares outstanding have been decreasing, which is a plus sign. That's going to increase your EPS. If we look at this chart here, this was 2017. They kept on buying the shares, which is great, a buyback, and that's going to help us on increasing shareholder value. The insider ownership is 12.8%, which is quite low. And if we look at the Simply Wall Street, most of it, 12.78%, owned by the founder. Okay, so it's a founder company. Mark Zuckerberg, everybody knows Mark. Sheryl Sandberg got a little bit more there. So the ownership is not great. It's not a lot, the insider ownership. So the insider ownership is not good, so that's why I put thumbs down. Talking about cash flow, it's about 19.9%, amazing free cash flow. It's just amazing company. But then the PEG ratio is only 1.54 here. Okay, even though the PEG ratio over here may look great, 0.47, but usually with the PEG ratio, we need to be careful that they usually only use the last 12 months of the EPS growth. But then 2021 is a different year. So I didn't use the last 12 months, but instead, I got my number into 1.54 I use a very conservative PE, which is 17, and I divide that by what I think, or the analysts also think it's about 11% in the next 5 years. The growth is not going to be like 20% a year. So it becomes like 1.54, but this is a very conservative, very, very conservative, because nobody knows what's going to happen in the next 5 years in terms of the EPS growth. So this is the valuation, which is quite high. I would love the PG ratio below 1 if possible. This one here talk about the iOS changes, and then the second is the macroeconomic challenges of the cost inflation. So I want to talk a little bit about this cost inflation. Think about inflation, right? Facebook is an advertiser. Advertiser is a very unique system or a unique business model because they help businesses earn more revenue. And if you are a business that helps other businesses make more money, you have a slight more advantage. And that's what I see with Facebook and Google. So even though inflation is high, but then these companies that generate money and they relied on Facebook ads, they will need to think about, okay, if I don't spend money in advertising, I am not going to get customers. They kind of need to, okay, we are going to lower our budget, but then we are going to have less revenue. Is that going to be okay with us? So this is the reason why Facebook, I believe, has got the moat, the competitive advantage, like both Facebook and Google, because businesses rely on their service to generate revenue. And that is an amazing business model, because you help other people to generate revenue. All right, so the next one, I'm going to talk about the valuation. I'm going to talk about two kinds of valuation. The first valuation is we are going to use the EPS, future EPS calculation. The actual was $13.99. That's the 2021 that has just gone. In the last 5 years, the EPS CAGR is about 20%. And in the last 10 years, is 92%. But then 20% is quite high in the last 5 years. But then if they look at the analyst estimate, let's take the analyst estimate with a grain of salt, because they look at the lowest and the highest, they take the middle. Okay, so when I look at it, the next 5 years is only going to be 11% per year. And even for 2022, they are very bearish. They think Facebook is going to make less than 2021. This is super bearish in my opinion. And I personally don't believe that this is going to happen. Okay, but then let's just put the numbers there to be conservative, right? And then I use the P multiples of 25 and discount rate of 15%. And I come up with a very conservative number of intrinsic value of almost $300. And then there's the stock price as at the fourth, and we see the margin of safety of 20%. All right. Now I use the multiple of 25 because that's the mean in the last 5 years. The mean, the average P is always about 25. Okay, so that's Facebook have got a margin of safety about 20% according to future EPS. And let's talk about the discounted cash flow valuation. Okay, so these are the numbers that I put in for now. The free cash flow for the next 5 years is 20%. Sorry, in the last 5 years is 20%, and then it's about 52%. So if I believe that the future free cash flow is 20, and then 15, then I get a margin of safety about 47%. The intrinsic value is about $448. Okay, but then 20% is, I think it's high, but let's just put 15 and 10. Gives me about 23%. Okay, so if it's growing by 15%, next 5 years, and 10%, and let's say we want to be super conservative, P multiples of 20, which is super low, then it still give us a 12% margin of safety. I also want to show you in the last 5 years of PE chart band with standard deviation. Okay, so this, I actually created this on PE in the last 5 years, and I just plug in the numbers. This is the numbers that I put based on the real EPS, and then I use a forward PE. So the way we read this chart is, this is the average PE according to the forward PE, and then anything that's here, which is a -1, it's already low. So anything here is cheap in terms of PE is cheap, but then if it hits this, it's even cheaper. And we can see here in 2020, the PE even hit about 15. So if the Facebook price can drop a forward PE of 15, that is super cheap in the last 5 years. And then based on this, we are sort of here, like 17.94. This gives me a comfort of, okay, so where is the price in the last 5 years? And looking at the past, it's the perfect time to buy. The next thing I want to talk about is the technical analysis. Okay, so this is a weekly chart, and it has dropped from $382 to $237. Okay, so if we look at how much drop they've done, they've dropped about 40% from all-time high. It's just crazy. And it has touched the 200 days of moving average. And in terms of the past, if we look at the past, only twice they've dropped below 200 days simple moving average. Okay, so this was back in 2018 and the COVID-19. And if we look at how much they dropped from the 200 days moving average, they drop about 10% there, and then they drop about 16%. So we can see that Facebook in the past, they've dropped 10 to 16% below the 200 days moving average, which I think they bounce back. If we look at the technical analysis, the support is about $221. and it's sitting just below the 200 days moving average. So my personal opinion, can Facebook drop further? Yes. According to technical analysis, there's a big support there. It may drop to 220 or even to $200, but I don't think it's going to drop to $200. Possible, but more likely it can drop to $220. And if we look at the Fibonacci retracement from the bottom here to here, you can see the Fibonacci retracement is about 61. Okay, and then this is, and if it drops further, it may drop even more. But according to Fibonacci retracement, 61%, it's pretty good usually to buy. It's a good area to buy here. I personally have bought more, and I'm going to put more buy price in around the $220. And then I'm expecting this to go back up in the next 5 years. Okay, so that's my technical analysis. My technical analysis says it's a buy. So guys, thank you so much for listening to me until the end. That's my Facebook analysis. What do you think about Facebook? Do you think the market is overreacting? Are you buying? Are you selling? Are you not convinced? What is your plan going forward? So thank you so much. Please do like, share, and subscribe to this channel if you haven't. And I will see you guys in the next video.